Hi everyone. Hope everything is going well for everyone. Okay, so let's start chapter 5. So in chapter 5, as you can see, the title is Profit Planning and Decision Making. So in this chapter, if you've got your textbook handy and you want to flip through to the chapter on page 179, we start talking about break even. Okay, and a break-even analysis, which I think you would have done in math in your first year. But a break-even analysis is basically when the amount of stuff that you've sold, so you've received revenue on, say, mugs, okay? And then you subtract off your costs that are associated, whether it's cost of goods sold, which we've talked about before, and say rent. Once you subtract everything off, then you actually break even. So there's no profit or no loss. Okay, so in this chapter, we're going to start looking at different ways to figure out what the break even would be uh, for for a product. Okay, so for example, if you thought about the projects you were going to do for this course, um, how much would you have sold? So if you were taking in students into a home to give them boarding, room and board for the year, what would your break even be? Like how many students would you have had to take in, or how much would you have had to have charged? Or if you were making meals to be able to sell. And for meals or even for specific recipes, you could do it right down to the actual recipe. How much would you have to sell each recipe for, or the ingredients after the preparation? How much would you have to sell them for in order to break even? Okay, so again, so that there's no profit and no loss. Of course, that's not our ultimate goal in a business. We all want to make a profit, but it's a good place to start to know, if worse comes to worse, I have to sell this much in order just to break even. And if you remember as well, that's not including your salaries if it's a sole proprietorship, because as a sole proprietor, you cannot put your salary into your business. It can't be listed as an expense that comes out of owner investments. Okay, so let's start having a look here. If you want to read over the learning outcomes for the chapter, it's mostly talking about break even and how to do an analysis. And it's actually, if you look at number 2, it's talking about fixed costs and variable costs. Well, variable costs are like your cost of goods sold. You only incur those costs, so they're variable, they change. You only incur those costs on the sale of a product, right? So if you remember looking at the cost of goods sold, that stuff is sitting in inventory until it's sold. So that's when it comes out of inventory and hits cost of goods sold on your income statement. Okay, so those would be variable cost. A fixed cost is something that honestly that's fixed. It doesn't change, or at least not in the short term, and no matter how many sales you make, you're stuck paying for it. So a fixed cost could be anything from rent to interest expense, because if you get a loan, you have to pay that interest expense no matter what, even if you don't have any sales. Okay, so those are two really good examples of fixed costs. So when we're looking at break even, we want to make sure that we can cover all of our variable costs and our fixed costs. Okay, and we're going to figure out different ways to look at these um, different ways to calculate the break even. Okay. And on this slide here, it's talking about different times that break-even analysis in your decision making comes in handy, right? And honestly, it is, oops, sorry about that, folks. Um, a break-even analysis in your decision making is always very important, whether you're looking at changing the pricing of new products, existing or new products, or services. If you're going to change the price, if you think maybe, well, if I price it lower, more people would buy, or if I price it higher, I wonder how much profit I'd make. Okay, so break even is always very important there. Um, Talks here about modernizing or automating an existing plant. Well, if you're doing that, most of the time you're getting rid of variable costs, which is your hourly employees, and instead you're putting in new equipment, which has the fixed cost of depreciation expense. Or if you're changing your cost structure, again, changing things, maybe you're getting rid of equipment and you're changing it back to more of a hands-on approach, which would be a variable cost, or your employees per hour. All right, what I'm going to try to do is keep these videos quite short. So that's a little bit of background on break even. And what I will do now is post this video and then I will move on to video number 2. I'm going to try to keep them around 7 to 8 minutes apiece. Thanks everyone. See you in the next, or at least talk to you in the next video.